Global stock markets are kicking off 2026 on a high, fueled by the AI boom. In 2025, US stocks gained double digits, hitting record highs, with 7 major tech companies accounting for half of all market earnings. European and Asian equities also reached new peaks, driven by investor optimism around artificial intelligence and expectations of further interest rate cuts. Bonds saw their best annual performance in 5 years as inflation eased, though it remains above the Federal Reserve's 2% target. Analysts warn, however, that this exuberance may be overlooking one of the biggest risks ahead, and that is rising inflation. Money managers are bracing for inflation to re-accelerate, driven in part by massive corporate investment in AI and waves of government stimulus across the US, Europe, and Japan. Hyperscalers like Microsoft, Meta, and Alphabet are investing trillions in new data centers, pushing up energy and chip costs. Experts say rising prices could force central banks to end their rate-cutting cycles, raising borrowing costs, slowing speculative tech investment, and potentially weighing on tech company profits. Inflation-protected treasuries and caution in debt markets are becoming a preferred strategy for investors. Signs of stress are already appearing. Oracle and Broadcom warned that soaring AI spending could squeeze profit margins, while HP expects memory chip cost inflation to pressure prices and profits later in 2026. Deutsche Bank estimates AI data center investment could reach $4 trillion by 2030, potentially creating supply bottlenecks in chips and electricity. Analysts caution that unchecked costs and rising inflation could reduce investor returns and slow the flow of money into AI.